So we have January 2nd, there was payment of rent, and the amount involved is 700. On January 3rd, purchase goods for cash $2,000. Now what we ask ourselves is very simple. I, as the cashier, my organization is purchasing goods for $2,000. So the question I ask myself is this: I am the cashier, and at this point we are purchasing goods for $2,000 cash. At this point of purchase, will I receive cash or will I pay out cash? The simple answer is this: I will pay out cash. And accordingly, the law says anytime you are giving out, the account involved should be credited. Credit the giver, debit the receiver. So we now go over and credit the cash account. So we credit the cash account with 2,000 went out as a result of purchases on January 3rd. The next question is January 4th, sold goods for cash $1,500. The question would be, when my organization sells goods for cash, as a cashier, it's my responsibility to receive all cash and to pay out any cash required. Now, when we sell, of course, cash comes in. So the question is, at this point that we are selling goods, is cash coming in or going out? The answer is cash is coming in when we sell. Therefore, the cash account will be debited. As the rule says, debit the receiver and credit the giver. As long as we are receiving, our account will be debited. Therefore, the cash book should be debited. So we go over now and debit the cash account with $1,500 that came in as a result of sales. So January 4, there was sales of $1,500 received. So it has been what? Debited. So what you have just done is very simple. All the cash received by the cashier has been debited. From the owner of the business, being represented by capital, he received $3,000. From sales, he received $1,500. Then when they paid rent, $700 was paid out. And when there was purchases, $2,000 was paid out. If you want to balance this account, it is very simple. We add up the total received during the period, which is 3,000 plus 1,005, which is 4,005. Then we now minus 700 and also minus 2,000. That is 4,500 minus 2,700. That is 4,500 received minus 2,700 paid out will give us the closing balance of cash. So let's see how the account will be balanced. The first thing you do when you are to balance is to look at the side that has the greater figure. The debit side has the greater figure with 4,500. Now, you look at the two sides. Which side has the greater figure? It is the debit side that has the greater figure, 4,500. That is 3,000 plus 1,005. Now, what do? You write down the figure here, 4,500. Now, 4,500 4,500. This 4,500 represents total cash received in January from cash transactions. Then you minus the amount paid out from this 4,005, and that is 2,000 plus 700. That gives 2,700. Then 4,500 minus 2,700 gives us our balancing figure. Now we have 1,800 as balance carried down, CD, C/D, that is balance carried down as at January 31st. Usually we balance account at the end of the month, as the case may be. This 1,800 is as a result of 4,500 received minus 700 minus 2,000. That is 4,005 minus 2,007 gives us 1,800. This is the closing balance of cash, or the amount that the cashier is required to give out at the end of the month. The cashier received 4,005. Cashier is not the owner of this money, but just an employee. So at the end of the month, he is required to give account on how the money was spent. And now, I received 4,005 as a cashier. I paid rent as 700. I paid 2,000 for purchases. Then I'm giving back to the owner of the business, or to the business, 1,800. And that is why it has been credited, but because at this point, the cashier is giving out value. But at this time, the money is being given out not because of rent, not because of purchases, but as a closing balance. If you add 1,008 plus 2,000 plus 700, it's going to give you 4,005. That means the account is balanced because the total amount received minus the total amount spent plus the balance at hand must be equal to the total amount received. You can see 4,005 minus 700 minus 2,000 gives 1,008. And everything still gives us 4,005, which represents the initial amount received from capital and from what? Sales. Now what we have just done is single entry. Remember that the double entry principle states that for every debit entry, there must be a corresponding credit entry. That is, for every receiver, there must be a giver. We looked at one side of this transaction. How? When the owner of the business introduced cash to start the business, the cashier received the amount and was debited. The question is, cashier is the receiver, where is the giver? The giver is the owner of the business that brought out the money, that is the giver. So the owner of the business needs to be credited. And to be credited where? In his personal account known as the capital account. The cashier received $1,500 from sales and was debited. We have only debited the receiver. Who was the giver? The giver is sales. Personified, the sales girl or sales boy or salesman, or the account that made the money to come in is the giver. Therefore, the sales account will be credited since the cashier has been debited. Let us go to the board now and demonstrate what I have just explained. Now, for the sake of our foundation knowledge, there is a method I want us to adopt at this stage. If you watch this account, capital account is on the debit side, sales account is on the debit side, rent purchases, they are all on the credit side. So what do? We have 4 accounts here: capital, sales, rent, and purchases account. So we go immediately and open the 4 accounts: capital, sales, rent, and purchases. You can see the accounts here. You can see the accounts here. We have the capital account opened. We have the sales account opened. We have the rent account opened. And we have the purchases account opened. These accounts were opened because they relate to the cash account transactions. Now, what we do in order to adopt double entry principle is very simple. Now, capital account is on the debit side here. Since it's on the debit side, once you open the capital account, credit it, as long as the entry here in the cash book is on the debit side. So we do that now. Now we have credited the capital account. On January 1st, capital made the cashier to receive 3,000. So the same way, on the same 2001 January 1st, capital gave out cash of what? 3,000. So what are we saying? The cashier received from capital and capital gave to cash. Capital cannot give to capital. Capital gave to cash. Therefore, the cash received from capital. So we have succeeded in debiting the receiver, that is the cashier, and crediting the giver, that is capital. If you are asked in this transaction, Mr. Victory started business with cash of 3,000. Which account is to be debited and which account is to be credited? Now the account to be debited is the cash account, while the account to be credited is the capital account, because capital is the giver, while cashier is the what? Receiver. Or while the cash account is the receiver. So we debited cash. Everything here is under cash account. So we debited cash account and credited the capital account for giving out cash to the cashier of 3,000 and debited cashier for receiving 3,000 from capital. Of course, cashier owns all these accounts and capital owns everything that comes here. Capital represents the owner of the business. If you observe again, sales made $1,500 to come in and the cashier has already received that. If you watch, sales account is on the debit side of the cash account. It is on the debit side of the cash account. Now, when you open the sales account, which we have already done here, since sales account is on the debit side here, immediately you open sales account, the balance automatically will be on the credit. Remember that for every debit entry, there must be a corresponding credit entry. So since there is already a debit entry in respect of sales here, as a result of cashier receiving from sales, therefore we open sales and have it credited since sales is the giver. Now we have credited the sales account. On January 4th, 2001, sales gave out cash of $1,500 to cashier. The money came out from sales and was sent to cashier $1,500. So sales is the giver, while the cashier or the cash account has received $1,500 from what? Sales. The transactions on the debit side, we have treated all. Coming to the credit side, we have rent and purchases. Of course, since rent is involved, we go and open the rent account. You can see it, rent account has been opened. Now, rent is on the credit side of the cash account. And the value is 700, showing that 700 has been given to rent. So since it's on the credit side, once you open rent, the entry will be on the debit side, in line with the concept that for every credit entry, there must be a corresponding debit entry. Rent is the receiver, so we debit the rent. For receiving $700 from the cashier. On January 3rd, spent or gave out 2,000 as a result of purchases. Therefore, we open purchases account. Purchases is the receiver and has to be debited. Of course, since purchases is on the credit side of the cash account, once you open the purchases account, it must be debited because it's already on the credit side here, showing that something was given to purchases. So the purchases is the receiver. So what do? We debit purchases with $2,000 cash. So we have debited purchases on January 3rd, 2021 with cash of 2,000 received from the cashier. Now if you watch all the transactions, the source of the receipt is cash. The source of the receipt here is cash. Here, it was given to cash. Here, it was given to cash. So when you see the words cash, 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 and cash, what it represents is cashier. It's either an account is receiving from cashier or the account is given to cashier. That is why we call this cash account. We say it's an account that records only cash transactions. It does this by debiting all the cash received and crediting all the cash paid out. Any account that it receives from, such as capital and sales, when you open the accounts, they have to be what? Credited. And any account that the cashier gives value or any amount to, such as rent and purchases, when you open such accounts will be debited because they represent receivers. This is what the double entry principle is all about. It states that for every debit entry, there must be a corresponding credit entry. Therefore, every debit entry, there must be a corresponding credit entry. Therefore, every credit entry, there must be a corresponding debit entry. And therefore, every credit entry, there must be a corresponding debit entry. So, what we have just done is to prove that for every receiver, there must be what? A giver. This is the way that transactions are recorded using the ledgers. We have already balanced this account and we have 1,008. That is at the end of January 31st. Assuming this business wants to continue by February 1st, this is an abbreviation for February, FEB, February 1. That is next month, beginning of next month. This 1,800 naira will be given back to the cashier so that the business can continue. Of course, the balance of 1,008 should be in the company's or in the business safe. Next month, this amount will be given back to the cashier for the continuation of the business. That is perpetuity concept in accounting. Now, once the money is given back to the cashier, it will be registered as balance brought down for the next month or the beginning of next month, February 1. This is how we record transactions in the cash account. You should note that the total amount received here is 4,005 and the total amount paid out is 2,007. That is why we had a favorable balance of 1,008 remaining at the end of the year. Assuming here they paid out 5,500, that is total of 5,500. It means that the total amount spent or paid out is greater than the total amount received. In such instance, the balance carried down will be at this side. I believe that from what we have learned, we have gotten a good idea about how the concept of the double entry principles is applicable in the ledger, especially in the preparation of the cash account. For our next stage, we are going to be looking at cash book proper, where we are going to be looking at the 1-column cash book, the 2-column cash book, and the 3-column cash book. We are going to be looking at various forms of journals. Journals for sales of goods on credit, journals for return inwards or sales returns, and journals for return outwards or purchases returns. We are also going to be looking at journals that are used to record the purchases of fixed assets on credit. We are also going to be looking at some aspect of journalizing. Of course, from what we have just done, you can always be able to identify accounts that needs to be debited and accounts that needs to be credited. For instance, when the owner of the business started business with a certain amount of money, it was the cash account that was debited. The account to be debited is the cash account, while the account to be credited is the capital account. When rent was paid, the account to be debited is the rent account, while the account to be credited is the cash account. When there was purchases, the account to be debited is purchases account, and the account to be credited is the cash account. When there was sales, the account to be debited is the cash account, and the account to be credited is the sales account. You must have a good idea of the account to be debited and the account to be credited in each transaction, as most of the objective questions will be drawn from here. Thank you as we go into the next stage.